All right, folks, welcome back. This is our algorithmic theory lecture and discussion on model number 8. Obviously, this is aiming for a 6% trading model and trying to build a career on 25 pips per week. Now, this could be 25 handles or 25 ticks in index futures. So don't think it's limited, obviously, to Forex. It's not. But having a very low threshold objective for the week, there's lots of ways to do it. You can do, for instance, let's speak on terms of the index futures market. Not that we'll deal with that entirely through this lecture, but let's assume for a moment we're discussing and focusing on E-mini S&P or E-mini NASDAQ. You could look for 25 handles for the week and trade with a low-end objective to try to capture just 5 handles per day and try to zero in on a session for each one of those days, Monday through Friday. And whichever session proves to be more likely to provide a setup similar to this, you can do that with 5 handles, take the 5 handles and move to the sidelines. And you don't have to have a big, huge time expenditure doing it. You don't have to sit in front of the charts for hours. You don't need to be in front of the charts all day. And capture your 5 handles, move to the sideline, and you build your 5 per day at 5 days per week. It's 25 handles for the week. And you can do extremely low risk with micro accounts. So the micro account allows you to do extremely very small risk per trade. Now you can also do this in the scope of one trade, one setup that frames a logical 25 pips or 25 handles or 25 ticks if you're going to be using ticks as your measurement. I want you to think about how you can utilize a set number of either pips or points or ticks that you're capable and you feel confident you're going to be able to do consistently. Because if you remember when I first started teaching on baby pips almost 12 years ago or so, think about that, 12 years, it's gone by quick. The idea of looking for 25 pips per week and trying to capture 6% return each month. And then that would double the account over the course of a year. So I'm interested in the folks that are on my Twitter feed. I posted a poll yesterday asking them, and obviously it's about 37,000 people. Not all 37,000 people are members in this community, obviously. And most of them are probably very new, just discovered me. And I asked them all to click on the poll, let me know what their annual salary is. Is it under $50,000 a year? Is it over $50,000 but under $100,000? Or is it over $100,000? So I gave 3 choices. And predominantly, you'll see the majority of all of the poll results show less than $50,000 a year. But these same individuals believe that they're going to try to make $400,000, $500,000, $1 million in a year. Usually with a $100 account. Not likely. So, if these same people would think about doubling their account over the course of a calendar year and thinking modularly, because when you're first starting out, you're not going to be able to go out there and hit 25 pips a day. You're just not going to. Or 25 handles a day. You simply don't have the experience to do it. And you're going to wrestle with that impulsive nature that you're fearing you're going to miss the real move. And if you don't get in right now, you're going to miss it. And you'll argue with yourself, I can be a little bit early if it goes against me a little bit because I'm early. I can deal with that. When really you're creating that opportunity for poor habit building. You want to go in with a very specific logic in mind, what you're looking for, why should it form, and framed on that weekly range expansion. Now, in this example, I'm going to show with you in this lecture, I want you to think about how at the beginning of the week, we don't necessarily know right away if our weekend analysis is going to be on point. Now, admittedly, I didn't go into great detail about what I think personally a Forex pair is going to do, because I don't know what Sunday's gap is going to do. I don't know if it's going to open unchanged. I don't know if there's going to be something that comes out over the weekend that changes the entire delivery of price. So we have to wait and see what happens. So you can use this model and never trade on a Monday. Even though Monday, Tuesday, and Wednesday are the ideal trades or trading days, you can elect to let Monday, which is what I've done a lot by teaching both publicly and in this mentorship, is to let Monday trade without you. It gives you intel. Okay? And that way we get a feel for what it's likely to do, and then either participate in Tuesday and or Wednesday with the expectation of knowing with more intel, more data, more price action from Monday, what it's likely to do relative to that weekly chart candlestick. Is it going to be expanding higher or lower? Again, we're not trying to predict the close of the weekly candle. We're just trying to see where is the range expansion likely to occur. And I kind of want to talk a little bit about it over the context of the British pound versus US dollar. But before I get into it, if you recall in our recent commentaries, I've had your attention on this SIBI here, and it's from April 26, 2022. So that way you can find it on your charts. That way the subsequent charts, you'll see these levels here, and I want you to know where they're linked to. All right, so I mentioned how we were likely to trade up into that before it happened, run the buy stops over here, and fill in this area here. That was the more refined imbalance, because you can see the hourly is here, from here to there, but it's refined on that 15-minute time frame. Notice how we traded up into it, going into that level here, and then it broke away from it aggressively. Then we had two institutional order flow entry drills here, and it broke heavy. So this high, this low, and then trying to get up through these levels, it failed. Took out this swing low. So now we have to at least give the measure of possibility that maybe this thing's going to expand to the downside. You may have had a bullish bias going into the week, or maybe you had a neutral bias. Okay, you didn't know what to expect, but you have to look at what price is showing you. So in here, we're going to use this logic that we've already moved away and repelled from that SIBI that's over here. We've already cleared buy side, and it has an unwillingness to go higher, and it snapped lower. So we're going to use that logic in here on a 5-minute chart. So when we're sitting and looking at the charts, we're trying to obviously work inside of the idea of not predicting prices closing value, but we're looking for volatility with a predetermined directional bias. And that bias doesn't need to remain the same throughout the entire week. We just need one trading session to be in alignment with what we expect that weekly candle to do. So for someone that's a hardline critic, that won't seem like makes any sense. You know, what's the point of even looking at the weekly chart or candlestick if you're only going to be looking at it for one session? Because if you're going to be participating in what you are hopefully going to be correct in your analysis, with the weekly range expansion being correctly decided by your analysis, so in other words, we're going to say it's bearish here, the likelihood of one session or one day offering a large range is always there. So that's all we're trying to capitalize with this model. That's it. That's all we're looking for. We don't need the full range either. So if you notice that we've taken out lows here, we retraced. Now, notice it didn't take out these highs. What did it do? It broke once more here. So we've taken out relative equal lows here, It could have rallied up and taken out buy side. It didn't do that. Once more, it broke lower, took out sell side again, and then rallied up into a fair value gap, optimal trade entry. During New York session, weekly range is likely to expand. Why? Because we've already shown it was unwilling to go any higher than that old civvy, and it took a higher time frame pool of liquidity that was buy side. So it's likely to do what? Expand lower. So if you'd used that logic and also incorporate SMT, so we're using some intermarket relationships here to beef it up. Dollar lower, low, that's what we're showing here. This is being plotted on dollars low value when GBP made a lower high. So we have dollar index SMT divergence or USDX SMT. So if we have this high related to this low in dollar and this high in cable related to this low in dollar, dollar went lower there respectively, whereas cable should have went higher than this high here, but it went lower at a time when it's optimal trade entry. So using this model and the logic, we can say, okay, well, I'm going to look at going short right back here for our fair value gap plus 1 pipette using a stop a pipette or so above the high. So zoomed in here so we can have a better feel for what we'd be looking for. The logic is we want to be able to see if we can get a run from here to take out the sell side below here. How far? Well, we can reach down 10, 20 pips below that. And we're going to frame it with a hypothetical $5,000 account. And you're risking 1%, that's $50. Okay, 50. And using that stop loss here and entry here, reaching down below about 20 pips or so, but plus the spread, fluffing it up a little bit, that would give us a $300 return or 6%. So one trade right here, 6%. You don't need all this, and it's an easy, logical setup. And once you get this, then you move to the sidelines and you wait and you trade another setup the following week. And if you just do that, you'll outperform any of the fund managers that are banded about as the upper echelon. They're not really doing all that much. So this model, in my opinion, is one that all students should start with as a goal. Try to do this one. And if you can be consistent about finding one setup, executing on one setup, and then stopping for the week. I posted this morning on my Twitter feed and said that there should be no more trading this week, and to test yourself, to all the viewers and students, not to engage the rest of the week. And I know 95% of them, if not more, are going to fail that. They're already probably 20, 30 trades in for today. So for the benefit of teaching yourself discipline and also being consistent, knowing what you're looking for, taking it, and then moving to the sidelines and not doing anything else. Now, does that mean you can't tape read or study price action? No. But as far as pushing a button and executing your demo account, don't. This should be your first model to practice with, regardless of how you want to trade, because this will help you with discipline. Discipline is one of the most important, overlooked, underrated characteristic of a developing student. They don't think it matters to them until they start messing around and realizing that they're not finding any consistency because they're lacking discipline. And discipline is something that's forged. I can give you exercises and things to help forge that, but unless you put it to task and hold yourself to it, you'll never learn discipline. Okay? So it's not about a lot of money being risked, because $50 from entry here to just above this high, $50 is nothing. Most of you are probably spending more in gas to fill your gas tank up now to risk that $50 in a trade. But how many tanks of gas can you pay for if you're taking $300 out of that move? That's how you need to be thinking about it. So while this isn't the be-all and end-all model, I believe that it's something that all of you should work with. And here's the thing. You can use this as an exercise each week. Not that this is going to be your model, but you should go in every single week with a bullet point list of things that try to practice and keep yourself good at. I do this very thing every single week. And sometimes I'm showing the actual example of me doing it to stay honed in on price with my little vignettes. Some of the trades I'm taking are based on this type of idea. I'm trying to capture about 25 handles in the index futures. Do the math on how many I'm taking out. My son just recently did it the other day, and he captured like $700. One contract in the NASDAQ. And he was thinking, well, this is going to be my bread and butter type setup. Is it 25 handles? No. But he felt confident that that number of handles, that's what he could do. And that's what he's trying to frame his model on. You're going to find that doing this over time will build confidence in your ability to find setups. Even when your choice model, perhaps the one shot, one kill, which is model number 9, maybe that is your cup of tea. But you want to start at least doing this initially, and then even throughout your career, always get in the habit of looking for these types of setups, because this is going to build confidence. Even if you have a losing trade, or if you have a period of losing trades and you have some drawdown, these are the reminders that this stuff works, and you just did it wrong once or twice, or maybe a series of trades. And discipline, okay, the ability to stop trading. Once you find one of these, you stop for the week. That discipline is what you're going to lean on when you have a losing series of trades where it's 1, 2, 3, maybe 4 trades you've had a loss on. You're going to lean on the benefit of the discipline you forged by saying, I don't have to go in again. And that will help you stop the bleeding, stop the drawdown, go back and look at your journal, go back and look at all the times that you used these concepts and they worked, and it'll build you up psychologically and emotionally to see your annotations, your own logic, and your own words in the chart, and your own examples in the past where you've taken demo account trades. It will help you get through those periods. So by having a routine each week of doing something always with the mindset of improving, this model here is beautiful for that. Because even if this is all you ever get to be in terms of a consistently profitable trader, if you can only just make 6% a month, don't let anybody tell you that is not good enough. That is a phenomenal rate of return. It's ridiculous. Unfortunately, especially as a charter member now, you know how easy that is in terms of a threshold. The problem is knowing it's easy and then being impatient to wait for the setup with the right framework, like I'm showing you here. That's the hard part, because you want to get in to get it over with, because you want to win. Or once you get in, you need to get out right away, and you'll grow impatient, and you won't hold the trade to your objective. You start questioning, what happens if it turns around? I don't want to have a losing trade. So all those things are fixed by this model, because not only is it an applicable model for equity growth, but it's perfect for practicing and honing and grooming yourself for a long-term career. So hopefully this has been insightful. Until I talk to you next time, be safe.